According to Governor of the Bank of England, Mark Carney, taxpayer bailouts of banks in trouble will be a thing of the past. In the proposal revealed earlier this week, regulators aim to put new rules in place requiring banks to hold more money for their losses, while forcing creditors and shareholders to take more responsibility for their actions. Mr. Mehdi explains.
A plan that hopes to end the mentality of too big to fail across the banking world would mean banks can no longer use bailouts to cover their losses. This proposal was unveiled by Bank of England Governor Mark Carney, who was chairing the Financial Stability Board, declaring that banks can no longer use taxpayers' money when their risks don't pay off. Under the new rules, a bank in trouble would have to fend for itself. Banks would be required to hold a buffer of bonds equivalent to 16 to 20% of their risk-weighted assets. They are also expected to have a minimum amount of cash set aside for their future losses. For this, Carney said in a statement, once implemented, these agreements will play important roles in enabling globally systematic banks to be resolved without recourse to public subsidy and without disruption to the wider financial system. Carney reassured that this global framework for governing global banks is ready to be agreed by the G20 group of major economies when they gather at a summit in Australia later this week. At the moment, the banking reforms will apply to 30 of the biggest lenders. But these rules may not necessarily apply on banks that are not considered systematically important and part of emerging economies, raising questions among analysts.
They will now be competing in all different parts of the world against banks that don't necessarily have to do that.
I see.
That will raise a big issue for them as to whether they want to keep on being as comprehensive as they currently are.
Nevertheless, regulators and governments are keen to learn lessons from the financial crisis to avoid the same mistakes from happening again. And it's now clear that bailouts for banks may have played a part in allowing big banks to become even bigger to a point where they are too big to handle.
Well, joining us live via Skype is Mr. Robert Oulds, who's a financial expert. Mr. Oulds, is this a solution to the whole concept of banks being simply too big to fail?
Well, it seems that Mark Carney is a little bit confused about what his role is, because it is usually the role of a central bank and a central banker to act as the lender of last resort to save any financial institution or bank that has got into trouble. That's a very important part of his role, but he seems to be moving away from that and saying it's down to creditors and shareholders to take the pressure. Now, of course, in many cases, they certainly should, but sometimes it just can't be afforded by them. The debts may simply be too great. So often it's actually the central banker's job to be the saviour of the financial system. It seems that he's really fighting yesterday's war. He's like a general fighting previous battles, not realising that things have now changed. In Europe, there's currently the situation where there's deflation, or almost deflation, in large parts of the Eurozone economy. If, of course, banks have to increase their capital allowances, their capital requirements, then, of course, that would mean they would be holding money back. And, of course, they would have to be selling assets to take more income, which they would then hold back, and they'd be taking money out of the economy. That may well be wise to increase capital requirements at a time of prosperity when the economy needs to be managed and to build up a buffer. But at this time, if money were to be taken out of the economy, that would be less growth available, because there'd be less money for investment, and there'd actually be real deflation because there would be less money, so prices would actually fall, which would mean that there'd be less economic growth because people would put off making purchases.
Mr. Carney did say that the bigger the bank, the bigger the cushion they would have to provide. That obviously, as you just said, would be quite expensive for these mega banks. But what option do they have to actually cover those costs?
Well, banks really do need a bigger cushion, but it's when they build up this cushion. If, of course, banks prior to the 2008 financial crash had built up a sizable amount of reserves, then they would have been able to better weather the financial storm, which many of them largely created. But of course, at this moment in time, with the economy suffering, they don't actually have the opportunity to build it up. They don't have the resources available, and they should be spending money. They should be forced and encouraged to invest in economic growth. That is what is desperately needed in large parts of the European economy, not just the Eurozone, also Britain, whose economy could actually be doing better despite there being some economic growth at this moment in time. So it seems that banks should be repairing their balances when they have the opportunity to do so, and when the economy is growing. At this moment in time, they should be forced to invest. If they have to repair their balances, then they would be taking money out of the economy. So it seems that they've got somewhat confused around which way they should handle this situation. Plus, of course, these rules will only apply to the largest institutions, which means that other banks will have more opportunity to compete, which will then lead to capital flight. So really what is needed is a much bigger solution rather than just putting the rules onto a few banks, because that would just mean that people take their monies out of those banks and put them into other ones, which in different jurisdictions, which have less stringent rules, which will create more capital flight. And this is really going to be damaging the whole economy of those that enforce those rules.
This isn't going to be implemented until 2019. Do you think, and obviously they said there has to go through some sort of consultation before it's passed into law. Do you think there's a chance it could be watered down by the time it goes into implementation in 2019?
Well, if of course the target for 2019 is met and they do proceed, then it will take time to increase the balances. So this would be some way off, but the implications would be hitting the financial sector now. So really, it is likely that they will go through, but of course, you need to have a think about what is the role of a central bank, what is the actual implications for the largest banks, and how will it prejudice them against smaller banks in developing markets, which may then be benefiting from others having more stringent regulations. So really, this is a very odd way of handling the situation, because it isn't a uniform way, it's not a level playing field, and that will just create more disturbances and more imbalances within the financial system.
Mr. Robert Oulds, I'm afraid I'm going to have to stop you there because we are short of time. Thank you very much for joining us, a financial expert joining us via Skype.